expect any additional rationalization of GST rates on automobiles to stimulate demand and improve affordability?
So 2025 was an interesting year where GST 2.0 brought in rate rationalization in form of lowering the tax rate on the smaller segment of cars at about 18% and pegging the rate at 40% for the higher or the mid segment. So expecting any more rate rationalization is a bit too much to ask. However, the industry is still expecting that some sort of relief can be brought in for inverted duty, where the formula can be extended to provide refund of capital goods and input services, or refunds can be provided in form of exports for the capital goods formula as well. So all this gets embedded into the cost of the vehicle, and eventually, if any relief is provided, it will go a long way in improving affordability.
But is the budget likely to introduce additional direct or indirect tax incentives such as lower GST, enhanced depreciation benefits, or income tax deductions to accelerate electric vehicle adoption and domestic manufacturing?
So, industry is hopeful for a revamp of the existing PLI framework, which was applicable for the automotive sector for electric vehicles and advanced automotive components. Industry is expecting if some relief can be provided for the domestic value addition norms and lowering of the investment thresholds. This will help those companies also take incentives which have not been able to get it so far on account of eligibility. Second is that there is also some expectation if somewhere around R&D, which is a critical area for the automotive sector, some tax breaks can be brought in. It will be helpful in aiding that in India. And thirdly, government, there is some announcement around bringing a capital goods incentive scheme, and there is a threshold for automotive also, which is kept. This will encourage the domestic manufacturing of the capital goods required for the automotive sector, which is largely dependent on imported capital goods so far. So all these put together, we are hopeful that there will be some good news in the budget.
Are there expectations of changes in custom duty structures on imported components, batteries, or semiconductors, and how might this impact localization initiative?
So, customs alignment is central to India localization strategy, especially with the schemes such as rare earth magnet scheme, which has recently been launched, or the DLI 2.0 scheme, which is in works for the semiconductors, or the ACC PLI also, which is yet to be seen how it performs. It is necessary that a calibrated customs roadmap is provided, which can ensure domestic value addition as well as near-term continued production in India. Uh, at the same time, industry is also somewhere hoping that the SVB, which is applicable when an import happens from a related party, it's called special valuation branch. If those norms can be simplified and provisional duty can also be done away with, then it will help with the industry expectations to get the imports faster and have a certainty with respect to the customs duties and the costs involved.
Do you foresee the introduction of green taxes, carbon linked levies, or differential taxation based on emission norms? And how prepared is the auto sector to absorb such changes?
India's sustainability transition in mobility is already being driven by CAFE norms, which is corporate average fuel efficiency. And as and when these are implemented, it is likely to incentivize electrification, hybridization, and other avenues which can lower the emission in India. What we discussed on incentives and the GST, inverted duty, everything put together will help the sector move towards sustainability. Already, investments are made towards EV platforms, efficient technologies which can lower the emission. So, everything put together is going to go a long way and prepare the industry for a sustainable future.